Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome. I'm Stephen Boland. We call this podcast Different Makes a Difference because sometimes you have to act a little differently than the crowd to get a better result. Doing so is hard. First off, you have to be different and right, but also it's emotionally hard to be different, and it usually means you're going against a popular narrative. Popular right now are stocks benefiting from the build-out of artificial intelligence processing. We have long argued that investors should maintain some exposure to this theme, and we still believe that to be true, but we think the US market has too much exposure for the average investor. And we recently recommended going further underweight AI. And we changed the rating on 3 of our AI-related stock recommendations to sell. Vertiv, GE Vernova, and Cameco all served us and our clients extremely well, going up between 5 and 15 times our initial recommendation price. They're still good companies, but the risk and return on these and other AI-related stocks is not what it was. So to talk about our view of AI-related stocks and why we're increasingly choosing to be different, I'm joined today by Odlum Brown's Chief Investment Officer, Murray Leith. Welcome back, Murray.
Hi, Stephen.
So, Murray, let's start by sizing up the S&P 500. And that's the main U.S. stock index. It's made up of 500 of America's largest companies. If someone were to buy an S&P 500 fund today, how much AI exposure would they be taking on? How much exposure should somebody have?
Well, there's lots of different ways to slice and dice it. But, if you take the direct beneficiaries of the AI revolution and then all the indirect companies that participate in it, because it's not just the Magnificent Seven companies that are obviously benefiting from the AI revolution. It's the utility companies that are growing faster because they got to build out the electricity grid. Energy companies, both traditional and renewables, are, needed to power the AI compute. The pipelines were hated a few years ago, but now people can see how we need to get more fuel to market, in large part because the power demands of AI are so huge and growing fast. So there's a lot of different companies that are participating. Commodity companies, copper is a popular theme for a number of reasons, but the AI revolution is certainly one of the reasons that's fueling that. We don't actually own copper; we own Finning as a sort of a surrogate play on the copper narrative, Albemarle for batteries. But there's a lot of participation. But more than 50% of the S&P 500 is either directly or indirectly benefiting from the AI revolution. In our portfolio, we actually still have a lot of gearing towards AI, but it's about a third of our model portfolio. So still a lot, but not more than half the case with the S&P 500.
Yeah, that's extreme concentration. And it kind of reminds of another time when the stock indexes became very concentrated in another theme, in a different theme. It's an episode you know well. You lived through it. I think you handled it quite well. It was the technology mania in the late 1990s. And at the time, everybody wanted technology stocks, and you were willing to be different at that time as well. Can you tell us a little bit about what was going on back then?
Yeah, I can. But, maybe I'll sort of back up a little bit and, acknowledge that being different is tough and can be stressful because you're often early. And early for a lot of people is wrong. And if you're a couple of years too early, it is very much wrong and it can be tough. So, earlier in May, the big hyperscalers, Amazon, Google, Microsoft, and Meta, they all reported their results in one day, and they were awesome. Revenues were up roughly 20% across the board, but their cloud businesses, where all the AI activities going on, reported even faster growth from, 30% in Amazon's cloud all the way up to more than 60% in Google's cloud business, with Microsoft in the middle. Just phenomenal growth rates for these businesses. Everybody beat their expectations, or the analysts' expectations. They raised guidance, they reported bigger backlogs, and they all upped their capital spending. The four of them together are now expected to spend more than $700 billion this year, which is just a staggering number.
Absolutely. I mean, we're often looking at companies that are growing 3, 4, 5% a year, and 10% is good. And these are massive companies generating humongous growth.
Absolutely. So you'd ask me, what was it like back then? And, I certainly have lots of memories, but I can use AI now to sharpen those up. So after those phenomenal results at the beginning of the May from those hyperscalers, I was driving home and I dictated to Anthropic's Claude, as I do often these days. And I said, I want you to pull the reports for Nortel and Cisco, which was the biggest company that was helping build the internet back at the turn of the century, and some of the other players. I said, pull their first quarter results from 2000. I want to know what those looked like and felt like. And the summary is that they were even more spectacular. Nortel's revenues were up 50%, Cisco's 55%. JDS Uniphase, which was they did specialty optical components that went into the fiber that powered the internet. Their revenues were up 155%. They all beat and raised their guidance, reported bigger backlogs, talked about capacity constraints that they couldn't keep up. Point being, rhymes a lot with what we heard on the first quarter results recently. The news was even more remarkable back then. And the point of bringing that up is that we know with hindsight that there was an absolute cliff around the corner. That was, the businesses went on to, report great results for the next couple of quarters, but into 2001, they fell off a cliff. And there was no sign of that at the time. Cisco's stock had already peaked at the time. Nortel would ultimately go bankrupt. The tech-laden NASDAQ index experienced a peak to trough decline of almost 80% in less than 2 years. And it wasn't just technology stocks that had a rough ride back then, following the euphoria that existed at the turn of the century. America's biggest and best companies like Walmart, Johnson & Johnson, and Coca-Cola, they had crazy valuations as well. A Canadian who bought the S&P 500 index, or an index fund, at the end of 1999 in Canadian dollars would have lost a third of their money over the following decade. So it was really quite a mania, and great things came of it, but not for the people that paid up for those stocks in the heyday.
It's an amazing story when you talk about the growth rate of these companies and the build out of the internet, which did indeed happen. It only made sense to buy these things, and it turned out to be an absolute disaster of an investment. I find it interesting. You've been telling a story around here recently about a belief back then that the internet was doubling every 100 days. Share that story, and what kind of lessons are you drawing from that?
Yeah, it came out of the scraping of the results from 2000 that I did with the help of AI. And one of the things that it served up was that the CEO of Cisco, John Chambers, had remarked on the conference call that the internet was doubling every 100 days. And so I pulled on that thread and said, well, where did that come from? And it's a pretty fascinating story. Where it came from was from an engineer at a company called UUNet, which was a subsidiary of WorldCom. And WorldCom, of course, went on to be the largest bankruptcy and fraud in American history in 2002. It was a company that built the backbone of the internet around the world, the fiber optic cables that circled the world and carried that internet traffic from country to country and whatnot. And they grew by acquisition. And it turned out they had some pretty fraudulent accounting treatments and were telling a story that just wasn't true. And their CEO ultimately went to jail for that sin. But this subsidiary company, there was an engineer that was tasked by his boss to build a model, a spreadsheet modeling out various demand scenarios so that they would know how to provision traffic on their network that they were building quickly around the world. And the doubling every 100 days was merely the optimistic scenario. But from there, WorldCom was in the business of selling bandwidth. And so that made its way into their marketing material. And before you knew it, it was repeated by the heads of AT&T and BCE, and it got written into government reports on the digital revolution. And the former chair of the Federal Communications Commissions even wrote a book, and it was in there. So it became gospel, but it was wrong. The really interesting thing is that 2000 was the peak in belief, but most of the really great things that came from the internet didn't come until years later. People knew that it was going to change the world. It truly did. But, most of the modern internet was introduced way after that. And I've got some examples. Google went public in 2004. Facebook was launched the same year. YouTube didn't come out until 2005. Twitter, 2006, as well as Amazon Web Services that same year, which is their cloud business is growing wonderfully right now. The iPhone. In the middle of the decade, we all talked about our Crackberries and thought that we'd be using those forever, but they were just texting machines at the beginning of the decade. But the iPhone came out in 2007, same year that Netflix started streaming video. And the Apple iStore didn't open until 2008, and Uber was introduced to the world in 2009. So, the belief that the internet was going to change the world was dead right. But what came next exceeded our wildest imagination. But the lesson is that investors got out over the skis and they lost, paying too much for these wonderful companies that were going to change the world. They did, but they paid too much and they lost a bundle. That's the lesson.
What's that Mark Twain quote? I can't remember it off the top of my head.
It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. And the irony with that quote is that it's been misattributed to him. I don't know who actually said it. It's a great quote. It drives our thinking all the time, but he didn't actually say it.
So sticking with the late 90s here, what eventually killed the bubble? These were very popular stocks. They came crashing down. What went on? What was the cause of it?
It was actually technology that killed the bubble. Ironically, internet infrastructure got overbuilt, part because people thought the internet demand was growing faster than it was. But the bigger reason for the collapse was the absolute drop in the cost of bandwidth, moving data around the world. The price of doing that absolutely collapsed because of technological advancements. And we laid all this fiber to move internet data around the world. Initially, those fiber optic cables just carried a wavelength of light, and that's how they moved the data around. But then they learned how to send dozens of wavelengths down the same pipe with different colors, and then it was 50 different wavelengths. And so they kept on developing new technologies. That's what the Nortels of the world and the Ciscos of the world were figuring out, how to turn 4-lane highways into 50-lane freeways. And so not only were we laying a lot of fiber, but we were increasing the capacity to push traffic down those networks tremendously. And so the price of bandwidth dropped 95%. So the people that had invested in the initial networks couldn't get a return on their investment. And so we ultimately used all of that bandwidth, and we had lots to grow into, but we had way more than we needed early on. And that's what really killed the party. The big constraint today is power. We don't have enough to build data centers at the rate that we want to. But there's a mad scramble to add all sorts of power. Natural gas is seen as the bridging fuel. That's why GE Vernova has been such a hot stock. They make the turbines that generate electricity from that natural gas. There's been a nuclear renaissance, and that's why Cameco has been just a spectacular stock. Renewables. The world's been investing more and more in renewables, and the need for them is even greater with this AI revolution. It's sort of all of the above, unfortunately and sadly. the world's embracing coal again. We were shutting down coal plants, but we're delaying that now. And so there's a race to increase our energy capacity as much as possible to feed this AI revolution. But, we'll figure out how to make the chips and the compute more efficient. And they're doing it every day. Like, they're making tremendous headway so far. Demand's growing faster than the technological advancements can keep up. I'm certain that at some point, boom will be followed by bust. The tough part is we don't know when. Is it going to happen this year? Is it going to happen 5, 10 years down the road? And that's what we're anxious about. I'm anxious about it when I'm underweight. It's part of the reason why I spend lots of time thinking about it. But the valuations of some of these companies are, they're discounting an expectation that demand and supply is going to remain tight forever. And that's not the lesson from history. Every technological revolution has had a boom bust cycle for the exact same reasons, we've been talking about.
Okay, so you mentioned that you don't know when this is going to end. You didn't know when it was going to end in the late 90s either, but I think there were some warning signs that you were seeing that made you go underweight technology, not own Nortel, for example. What were those warning signs, and are there any parallels there to what we're seeing today?
Yeah, there were warning signs, and you're right. We didn't own Nortel, but we did own a company called Alcatel, which was the French counterpart to Nortel that made telecom equipment. And they were growing about as fast as Nortel, but they traded at half the valuation multiple, 35 times earnings instead of 70 is what I remember. And there was two things that happened that I was getting nervous with the valuations and wondering when we were going to transition to some other stocks that were better value at the time. And I had woken up one day and read the paper and read about the TD Dividend Income Fund that had a third of their portfolio invested in Nortel. And Nortel barely paid a dividend. It was like 0.009%. And you thought, well, when a dividend fund, a big dividend fund, has a third of the portfolio in a business that doesn't really pay a dividend, who's left to buy the stock? So that was number one. And number two was, I remember reading about a bond conference or a fixed income conference in New York. And a speaker there had surveyed the crowd and said, who's going to invest in the telecom companies that are financing this huge build out of the internet? And nobody put up their hand. And I thought, that's a real sign that the party's over. Everybody's already bought, and the people that are financing this are done. And there's another, I think, lesson in this is that the memory that we all have, and certainly it was the memory that I had until I started to think about it, is that the trigger for the collapse was the bond market refusing to lend to these startup telco companies. The incumbents were doing it too, but there were so many startup companies that were raising money hand over fist. And when the bond market said, we're not giving you money anymore, well, that meant they couldn't buy equipment from Nortel and Lucent and all these companies. But the demise of those companies was the symptom. And the collapse of the telecom, the incumbent telecom company share prices was another symptom. The disease was the technological advancements, the collapse in the price of bandwidth, the deterioration in the economics of building the internet. Like, people couldn't get a return on it. And the here and now, we find some comfort that the people financing the AI revolution primarily are these big companies, the Microsofts, the Amazons, and whatnot. And they are, they're amazing companies. They're diverse businesses. They're not going to go bankrupt. They're going to be around forever. And that's part of the reason why we still own them. But they're not the businesses that they once were. They're not capital light anymore. They're spending tremendously. Their free cash flow is going down because they're making all these investments right now. Now, there will be a payoff, but how long will it take to come and how big will it be? They're now borrowing. They used to have piles of cash. So the multiple that investors will pay for them will not be as high. That's why they're not as valued as sky high as the Nortels were at the turn of the century. But what we need to watch is the economics of building these data centers and whether or not demand will continue to outstrip the technological advancements. And we're not there yet, and we don't know where that's coming, but we've got to be careful about the price that we pay for that to make sure that our clients get a return on their investment. So that's what we're focused on.
Okay. I want to touch as well on circular financing. It's something we've talked about before on this podcast, but just remind us what you saw in the late 90s around circular financing and what you're seeing today. And maybe just start, what is circular financing?
It's what's going on in this era. There's something a little different that rhymes with it from the internet revolution. But what's going on right now is the suppliers of the technology are investing equity into their customers, and then the customers are buying from the suppliers with that, money. NVIDIA invests in their customers, and the customers turn around and buy NVIDIA chips. Microsoft invests billions into OpenAI, which is ChatGPT, and then OpenAI turns around and buys compute from Microsoft's cloud business. And so there's a lot of this sort of circular financing or investment going on, and it helps perpetuate. It's good for everybody in the chain. And that wasn't so much of what was happening. There was a little bit of that happening at the turn of the century in the internet revolution. But what was happening more was vendor financing. So Nortel would give equipment to a startup telco and say, you know what, you can pay us once your business starts maturing and you have cash flow. And unfortunately for Nortel, those businesses never came to, never flourished. So they ultimately weren't able to pay that money back. And the magnitude of this circular financing that's going on today, it's similar in size to the scale of the vendor financing that was going on back then. So it's a bit of a flag on the field, something that we're watching. The players in this game, they're all very well capitalized and funded, but the Anthropics and OpenAIs, they constantly have to go back to the market for more client financing. And I think the worry is that, this build out of data centers and growth and what AI will do for the world will continue for a long time. But, some of the companies that are participating in the hottest stocks, the Vertivs that do the cooling and power systems for the data centers, or the GE Vernovas, or the Camecos that we've talked about, they're susceptible. Their valuations are very high. And if these hyperscalers, the Microsofts, the Amazons, the Googles, take their foot off the accelerator just a bit, I think those are the kind of stocks, if the experience at the turn of the century is a guidepost, those things could hit a huge air pocket, just when those guys decide it's time to, still build it out, but slow it down. Those things I think could drop like 30, 40, 50% in short order. And that's why we've moved on from them. And it's tough though, because they keep running in the short term. And, we can talk about, our experience back at the turn of the century with some of that.
Yeah, I just want to pick up on the valuation point there. And just to put Vertiv into context for people, when we recommended Vertiv in, I think it was 2021, it was earning about $1 in earnings per share. And we saw the potential, I can probably get to $3. And if this is a stock that can trade 15 to 20 times earnings, you got a $45 to $60 stock. The stock was $20. And then AI came along, and all of a sudden, there was the potential to get to $7 or $8 per share. It's like, okay, well, you give 20 times on that, you could have $150, $200 share price. And now there's a bull case of $11. It's even getting thrown $20 out there. And this is a stock that's trading $350. So all of a sudden you say, this was a company earning $1. And now there's this bull case. We don't know if they can get to it of $20. Well, it's already factoring in the bull case. And there's a whole lot of downside if that doesn't come about.
Well, and I'd remind you, because you're the guy that covered that name, recommended it at 20, but it fell in half before it went on this huge win. So it's been a 15 bagger, or more than a 15 bagger from our initial cost, but it's been like a 30 bagger plus from the low. And they of course had a stumble when the inflation from the pandemic hit, and they didn't have inflation escalators in their contract. So, but that's a reminder that, these things can go from absolutely loved and you have to be thinking differently than the crowd at those junctures, or else you can get really hurt.
Yeah. It paid for a long time riding the valuation higher. And we did that on a lot of stocks over the last number of years, not just Vertiv. But I think you're worried that maybe riding higher price stocks won't be as lucrative as it had been in past years, that the valuation might make more of a difference going forward. Can you expand on that point?
Yeah, it's something that's very much on our mind. And, for most of my career, or for all of my career, we lived in a disinflationary environment. And what disinflation is, as opposed to outright deflation, it just means lower and lower inflation over time. And inflation peaked in the early 80s, and it didn't bottom until the pandemic. But as that happened, inflation has a huge influence on interest rates. And so as inflation came down, so did interest rates. And just as drops in mortgage rates have a positive influence on home prices, same thing happens with all assets. And so this 40-year period of disinflation drove higher and higher valuations. And the biggest beneficiaries of higher valuations are your growth stocks, because they report better things far into the future, and the lower the interest rate or the discount rates, the more valuable those future earnings are. And so valuation multiples have expanded for decades. But we're on the other side of that. We're in a different regime, a different era, where I think, we're going to be living with higher inflation. I'm not saying runaway inflation, but higher inflation and generally higher interest rates. And that puts the popular growth stocks that have the higher valuations at risk of those valuation multiples contracting after decades of watching them expand. And so for the better part of the last 2 years, we've quietly been rotating out of the more expensive names. And the names that we've sold most recently are among the most expensive. And we still want to own businesses that can grow, but we're much more conscious of the price that we pay for those businesses today because of that inflation and interest rate backdrop. It's different going forward. And most people, they live their whole life under a different regime. And we understand the relationships and how the world works in that world, but we're not in that world anymore. So we have to think differently.
Really hard to do. I mean, it's hard to get off the bus on something that's been treating you well. I know I've been selling down some of my AI winners like Vertiv, and it kills me to look at the tax bill I'm going to have at the end of the year. How do you get around things like that?
Well, it's true. And I can say earlier on in my career, I was a young analyst, and I didn't have a big portfolio. So I could think about these things more objectively. And, older and later in my career, unfortunately, I have a decent portfolio. But the unfortunate thing of things working out well and holding a bunch of great companies for many, many years is that I, like a lot of other people, have these huge capital gains, and I don't want to pay the tax man. But maybe a little retrospective here to shed some light on just how that influences people. Back in 2000, Nortel was our firm's biggest position. You might say, well, how could that be? You weren't even recommending it. But BCE had been our biggest position, and which was a perfect stock for conservative investors because they paid a big dividend. They grew that dividend year in and year out. And so it was our biggest position, but they also owned a chunk of Nortel, and they spun that out to investors in early 2000. And so Nortel became our biggest position. And starting in June of 2000 through to June of 2001, I wrote 12 sell reports on Nortel, and I think we only sold about 5% of our position. Like, people didn't want to pay the tax. And one of the points is that maybe it was easier for me to do that earlier in my career, where I didn't have skin in the game and I didn't have a big portfolio with a bunch of capital gains. And so it was easier to serve up the objective advice on, we should really move on from this thing. Whereas it's harder. And, we started buying America's best companies in the mid 2000s. And so, a lot of them we've been holding for, upwards of 2 decades, and not all of them, but we've been building capital gains in a lot of these great companies. And, most of the times you just want to hold great companies. People can figure out what are the great companies. And, Warren Buffett says, buy the S&P 500 index, just hold that forever. And that's great advice almost all of the time. But every once in a while, the euphoria, the belief in these businesses gets too grand and the valuations get too high. That happened in the early 70s with a group of stocks called the Nifty 50. It happened at the turn of the century, not just with the internet revolution, but with America's biggest and best companies. And it, I think, exists today. Not as bad as it was at the turn of the century, But I think it's a time that we have to be, we have to move on from some of these stocks that treated us very well and look for better value outside of the spotlight. And so that's what we've been telling clients.
So where are you finding better value?
Well, our biggest overweight is energy. And, we were overweighted before the Iran war. And sometimes that's a sad way to get lucky, but that certainly has helped. Because it was one area of the market that people still really hated. And these companies had gotten a lot more disciplined in the way they handled shareholder money. They were giving a lot more money back to shareholders vis-a-vis dividends or stock buybacks. Their balance sheets were better and their valuations, they were generating lots of free cash flow and you weren't having to pay up for it. People were worried about a glut of oil in the near term this year. Those worries, of course, have all gone away with the closure of the Strait of Hormuz. But there's a tight correlation to global growth and energy consumption, all types of energy. And I think we're all learning that oil is an input to a lot of the products that we use in our everyday lives. And, we all want to wean ourselves off of that and, build renewables, and we invest in renewables as well. And that will continue to grow in importance. It's an area of the market that we think people are, even today, still too cautious. The semiconductor part of the S&P 500 is like 17% today. Energy is like 3 or 4%. It's the complete opposite of where things were in 2007 before the financial crisis. Back then, energy was 17% of that index and semiconductors were 4%. And we're much more comfortable being in the far less crowded trade.
Yeah, that makes a lot of sense. I think that's a good place to end it. Thanks for joining today, Murray. I think the parallels you're drawing to the late 1990s are quite interesting. The build out of the internet did indeed change the world, but many investors lost a lot of money owning wildly popular stocks when that investment cycle turned. Today, the US market has high exposure to AI related stocks. Certainly some exposure is fine, but keep it measured. The stocks are popular and there are risks. It's emotionally hard to be different, to risk missing out on a popular theme, but it increasingly seems like we're at one of those times when being different will make a profitable difference. Thanks everyone for listening. We look forward to talking again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.